Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Friday, October 4th, 2024. Today's episode, we start with the unemployment rate coming in lower than expected. The job numbers were very strong. This is from Market Watch, the U.S. non-farm payroll, which is a hugely important number. Very notably, our last reading of this was 159,000. The expected was 150, and instead it was a whopping 254,000. This was completely out of left field here to add that many jobs. And, you know, one little divergence here notably is that with even adding that many more jobs than expected, well, why didn't this drop further, the 4.1%? It just means that what it means is that more jobs are being filled, but even, you know, there's still enough people trying to get work that aren't getting work to still keep that number elevated at the 4.1%. However, looking at the chart of the unemployment rate, you can see that this is no longer just going straight up. You know, if we take the August reading of this at 4.2, you know, that this isn't just a dip. This is now kind of like cracking lower, right? So this is sideways motion. Can it go up from here? Yeah, but it can also go down. And so the market crash is no longer imminent in my book. So we're going to change the crystal ball rating to, I'm going to change it to bear market soon. I'm less bearish than I was before. I still am bearish, but just less so. Not much has changed in my daily reminders. Unemployment may be low and rising. It is still in a trend upwards. It's more like going sideways though, but this sum rule was still triggered in July. That didn't change. Another thing that actually did change, though, was we had 75 basis points priced into the Fed funds futures for the rest of the year, and now it dropped to 50 the way the Fed actually said. And so the Fed funds futures finally believes Jerome Powell when he says we're doing 2 more cuts for the end of the year, guys. That's priced in now. So, you know, and can that change? It can change on Monday, you know. Ira Epstein, a guy that I watch, a YouTuber on markets, technical trader, you know, said, you know, these things, they change daily. And it was a response to a comment I made on his video saying, like, why are you, because he actually is predicting no cut in November, interestingly. This guy's in his 80s. He's been doing this since he was like in his 20s, like, and so he has so much experience with this. You know, you got to take these guys that have been around for a long time very seriously. Could there be no cut in November? You know, the way that I look at cuts, I just got to use the Fed funds futures. It's way smarter than me. It's what, you know, the people that are literally betting money on this are saying that's what the odds are right now. And so to believe otherwise for me is not really worth it. But it is interesting that there are professionals out there like him that see just the next month meeting as perhaps not even having a single cut. But, you know, it could be one of these things where we get like 0 cut and then a double cut in December. It's like, it's hard to say right now. But this jobs report was totally out of left field for me. As you've been hearing on me on this show, I was saying like, oh, you know, well, what if it jumped up to 5? I mean, the chart looked like it was, you know, it could have been going that way. If you looked at the direction and the momentum, this could be like the real crash here. It doesn't look like that now. And so now it's like, for me, it's all about just taking the data as it comes in. I still think one of the best places to be right now for myself speculatively is short junk bonds, because yeah, the yields went up today and that's going to hurt junk bonds, and it's going to hurt junk bonds more. It's going to put more pressure on junk bonds the higher they go. And with credit spreads this tight where we are in the cycle, I still think that's a really great place to be. But as far as the stock indexes go, with the NASDAQ, S&P 500. It's possible we could get to new highs. We could start seeing a bear market being priced in now anyway. I really have no idea. If yields continue to climb, I'll see that still as an opportunity to add to long bond, long duration treasury bonds, at the very least to maintain a 50% allocation for myself. But I'm not going all in, obviously, on this data. This jobs number is strong. Anyway, so then, is it a soft landing? And looking over to CNBC.com, their headline of the day, Fed close to pulling off the elusive economic soft landing in 2024 after a great September jobs report. These are typically the headlines that you get, by the way, before a major crash. And so it's almost, you got to wonder if somebody's just like, I'm not a conspiracy guy, but you do have to wonder if there's somebody pulling the strings out there to make it look good and make everybody calm before they really do the rug pull. I think it's likely for it to play out that way still, but I'm not I sold my puts on the NASDAQ, for example, today. Also long dated, I had this LEAP, which is a long-dated options contract for TLT, way out of the money, that I sold today at a minimal loss, because rates could be higher for a little bit longer here, longer than I expected at this point, especially just with this report. So yeah, one little change in the daily reminders. I'll read through all of them again on Monday. The crystal ball reading now is that a bear market will begin soon. Not necessarily imminently, and I still believe we will be in a situation where the Fed won't cut fast enough to save the economy, but it's not obviously falling apart right now. On to some charts. We're going to start with the S&P 500. So off of this good news, the market went up. So yeah, good news is good news. We were sort of prepared to fall apart here, and we didn't. The reason why I say I don't know if we can go higher or lower here is simply the fact that we're still in a situation where the PE ratio of the S&P 500 is 30, which is insanely high. Also, if you look at the Shiller PE, or they call this the CAPE PE ratio, I believe, too. This is unbelievably high. This is very, very high. This is, when this thing is very elevated, this is 1929 kind of a thing going on. So these things tell me that it would make sense for the S&P 500 to go down here. I mean, I think the market's being stupid if it keeps going up, but with jobs not falling apart here, people have money to continue putting it into the S&P 500, making the price go up here. So we could have another leg up. We could have some kind of, that's where we are. Off of this report, I'm surprised the VIX did not drop more today. It didn't drop that much. I would think that, super strong jobs number would make the VIX drop to the floor. Instead, it's pausing here. That's very interesting. TLT, it's still my favorite place to be. I'm 50% in it, and I'm not going to. I'm just holding this until we get the real landing here, which I still think is going to be a hard landing. I mean, the whole easy landing thing doesn't typically happen, especially with the yield curve being inverted so long. And again, the Fed is still strangling the economy. Rates are still above the inflation rate. They're still above the rest of the yield curve. That we're still in very restrictive territory. We're headed towards less, maybe a neutral stance, but we're sitting in a restrictive environment still, just slightly less restrictive with that first 50 basis point cut. So I still think this is a decent place to be. And like I said, as it drops and it gets below 50% of my portfolio, I'll be adding to long duration treasuries at this point in the cycle. It doesn't matter if you have junk bonds or treasury bonds. All bonds go down when yields go up, and so HYG is going down again. Like I've been saying, like my favorite speculative position is still short junk bonds. That hasn't changed at all. Now that we have yields going higher, well, that makes junk bond values go down anyway. So everything is honky-dory according to this report, and it should put pressure on junk bonds. And the more pressured junk bonds get, the more likely they are to have more pressure. Once you have that start rolling on itself, it's kind of hard, snowballing or whatever. It's kind of hard to stop. And with credit spreads super tight, we only have a 3% spread between junk bonds and treasuries right now. There's a lot of room for junk bonds to lose value right now. DXY, sorry I don't have the thing in the background, going up here. So I wasn't sure if the dollar would be, maybe taking a breather, maybe going down because of the fact that with good job numbers, well, inflation typically comes along with that, which would normally put weakness on the dollar, but instead the dollar rose today. As I said earlier in the show, I don't think I showed this chart. This is the CME Fed Watch tool. We now have only 2 cuts priced in. You can see right here for the rest of the year. Yeah, I put it in I updated my daily updates, but I didn't show this chart. So yeah, there's still potentially 3, but the market's now pricing in only 2. This is Bitcoin, got a bid today. This makes sense. With a strong jobs report, it means people have money. They're gonna have disposable income, so Bitcoin can get a bid here. I'm almost wondering if we really are going to see a leg up to the $100,000 range before the bear market sets in. But it's still way too speculative for me for all of my daily reminders. I still think that it's a good time to be very cautious. Oil getting a little bit of a bid here still. I'm a little surprised that oil did not shoot up higher with these good job numbers. I mean, clearly Americans are going to be using more oil if, we have more jobs, more production, if the economy is doing well. I mean, so oil doesn't really fully believe the narrative, not yet, it seems. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.